Okay, thank you very much for joining in. I'm Mr. Mwanza. Okay, I'm Manasseh Mwanza, and I will be able to take you through this course, which is bank operations and lending. Okay, so it's a very interesting course. And as a foundation, we are going to start with some of the basic concepts around bank operations and lending. One of the things that we'll look at is really we'll have to revise and have a bit more understanding of what we mean when we say a bank. I know it's a very basic definition, but it is something that we need to even appreciate a little bit more. What about the role of the banks, okay, in an economy? Okay, and basically what does it take to operate or to start, operating a bank in Zambia? Other than that, we will have to look at, some of the standards that we are looking for a bank to run, some of the physical as well as operational standards. So that's basically what we are going to do. Okay. All right. So the question is then, what is a bank? Okay. So we'll obviously define, but we'll also look at a key concept called intermediation, financial intermediation, but also the key characteristics. Now, really quickly, think of a 50 kwacha. Okay. Okay. 50 kwacha, the Zambian note. Okay. And then, actually it happens that money, will only have value, especially when you put it in a bank, because without a bank, okay, as in without the entire banking system, you find that money is just a piece of paper. Money is just, a piece of paper, and it looks to be useless. Okay, so we're talking about a 50 kwacha. It will be useless. What do we mean? Because the next thing that you do is probably maybe put it under your mattress, right? But really, when you do that, when you put that money, you hoard, in short, hoarding your money, you find that it will not earn any interest, obviously. Okay, so meaning that when you hoard your money, you haven't put it in a banking system, interest, there is nothing, there's no interest. Talk about things such as it being, especially it being used to pay for something in a different country. You can't do that. Okay. Okay, payment in a different country. Okay, especially that we are looking at international business as well in this course. So you are finding that this same money, this 50 kwacha, is useless because if you don't put it in the banking system or the financial system, it will not earn any interest. Okay, and then the other reason why it might be useless is that you can't even use it in a different country to make payments. Okay, and then the other thing is that, and this is very important, is that there is obviously someone who is in need of this same 50 kwacha. Okay, there is an investor, there is maybe an entrepreneur somewhere, an SME somewhere. Okay, on the deficit unit, okay, in need of this, but they will not have access to this money as long as you are hoarding this money. Okay, and these are the problems. Okay, and that is why we are saying the bank has to come in. Okay, because the bank is coming in so that it can transform, I think this is important, so that it can transform idle money. Okay, so that it can transform idle money into economic power. okay, into economic power, okay, or into investments, okay, into investments. That's basically what we are trying to do. And so that is why the banks are critical, okay. But let us look at the definition. Okay, so if we look at the definition there, you're able to see that a bank, okay, is a financial establishment, okay, um, that uses, right? So a bank is a financial establishment that uses money deposited by customers for investment, okay, and then pays it out when it is required, okay, and then makes loans, okay, at interest, and then also they're involved in exchanging currency, so that now that 50 kwacha can now be useful, okay, for example, in a different country where you may want to make some payments. So there's that conversion that is happening because of the bank. um Now, I think, just to slow down a little bit here, so what we have seen from this definition is that, firstly, we are seeing that the bank is using, okay, is using the money that is deposited by customers. In other words, okay, the bank isn't using its own money, okay, okay, isn't using its own money, okay. Instead, it is using the money of, the customer. So that is one thing that you are appreciating from that, definition. So there are different, various number of, in fact, millions of customers, in the banking system, and basically the money that they bring is the money that the bank is using. Okay, and then we are seeing that it is also saying that it pays out. I think this is also very important. So it pays out these monies when they are required. Okay, now that is profound, because what we are saying is that the bank, um, you know, every time you want to withdraw your money, okay, okay. So for example, you want to withdraw a 200 kwacha from an ATM, you should be able to access your money. Okay. In other words, we are saying that deposits, okay, deposits are repayable, okay, are repayable, okay, are repayable, are repayable on demand, okay. So ideally, the bank is supposed to honor that, okay, that obligation. Other than that, we are also saying, I think the third part here is saying that the money that it gets is actually being used, okay, the money that it gets is actually being used to create an asset that we call a loan. So a loan is an asset. So it creates a loan, okay, creates a loan. And remember that with a loan, what it is trying to do is trying to benefit from interest rate differentials, okay, or the net interest, okay, the net interest. What we mean is, this is the interest between the amount, I mean the rate at which the bank, borrowed the money from you and I, and then also the rate at which the bank lends out this money to their customer. Okay, so I think here, maybe just a simple task, I would ask a question in your own time as you view this material. In your own time, I'm trying to see, okay, what if, okay, we have a question. So what if you deposited 100,000 kwacha, okay, at 5% with a bank? Okay, you deposit a five, I mean a 100,000 kwacha at 5%. Okay, but the bank lends this same amount. Okay, so the bank lends this same amount, the 100,000 kwacha, but it is lending at 12%. Okay, at 12%. So the question that you can answer for me as you are going through this material is, what does the bank earn, right? What does, okay, the bank, okay, earn? Okay, so just check time and then see what you can do with that. Okay, in other words, we are looking at the net interest that I'm just from talking about. Okay, so that is that. Okay, so yeah, so just a couple of things. Just appreciate the issues of the banks managing liquidity. Okay, the fact that they're lifeblood of the economy. Okay, they ensure that money flows from, to where it is needed. Okay, and then I think let us quickly now discuss the concept of intermediation, because what is happening is, and I think we have kind of mentioned this, but what we are saying is that financial intermediation simply means taking deposits, okay, from savers, and these are the surplus unit, and then we are creating an asset called a loan, okay, and we lend to the borrowers. So the borrowers are the deficit unit. Okay, so I hope we are making some good progress. I hope this is making sense. Okay, yeah. So financial intermediation here. I hope you are able to see the diagram that I'm sharing. So basically, this is how financial intermediation works. Okay, this is how financial intermediation works. So basically, what we are saying is that we have got a surplus unit. Okay, we have a surplus unit. So these can be individuals, these can be businesses, these can be institutions. But what are we saying? We are saying that they have more money than they currently need. Okay, than they currently need. And how do you know them? Usually, these will be savers. Okay, these will be, for example, maybe investors. Okay, and so on and so forth. Okay, okay, and so what happens is that these people, okay, or these units will make deposits, okay, to a bank, an intermediary here, a bank. So the bank basically will accept these deposits, okay, and then it will make an asset called a loan, so loans. And so these loans will go to the deficit unit. Okay, so the deficit unit again can still be the businesses, okay, the home buyers, the student somewhere, an SME, an entrepreneur somewhere, okay, a company, okay, even government. But what are we saying? We are saying that in terms of like this unit needs more money than it currently has. Okay, and how do you know them? Usually these are borrowers. Okay, these are borrowers, these are issuers, okay, okay, and so on and so forth. And then what happens? This loan is not free, it has to be repaid. And so they will make this repayment, and then the initial depositors are given at least an interest, okay, for sacrificing consumption, right? It only makes sense that way. Okay, and of course these guys are repaying with interest. Okay, okay, and that is obviously a consequence of getting money that they don't have. So that's basically what interest rates is all about. So yeah, so really this has got a very significant um consequence to the economy. Okay, just this whole process that we've talked about here, the financial intermediation, really it is needed for any and every economy. Why are we saying this? We are saying this because idle capital is mobilized and is moved to where it generates the most economic value. Okay, I think that is very, very, very critical, because instead of this money just staying idle somewhere, it is being now used to maybe to build a school, right? Okay, maybe to build a school, to build a hospital, to build roads, okay, a new factory and so on, maybe to start a business. Okay, and so that is why we argue, as bankers, that uh, no economy can actually develop without a functional banking system. Okay, it can't happen. Okay, so that is basically why the financial system is very, very, very critical. I hope we understand this and we can explain it. Otherwise, as you are studying, make sure that you are able to appreciate these concepts from a practical point of view. For example, practically, who is on the surplus unit? Okay, okay. Look at a civil servant, for example, who is currently having a savings account. Yes, that's a surplus unit. Okay, look at that farmer who needs a loan so that they can buy some inputs for their farm. Okay, meaning that that is a deficit unit. So look at it from the practical point of view, not just memorizing, but appreciate the whole concept. Okay. Okay. So yeah. We are still looking at what is a bank, and I think we have gotten to a point which we really need to appreciate here. And the point here is, what are the key characteristics of a bank? Okay, what are some of the key characteristics of a bank? The first one is that it deals, in money, right? It deals in money. Okay. Now, what is very interesting there is that it is dealing in, other people's money, right? The depositors. Okay. And this is very unique, because if you compare a bank to maybe a retail shop somewhere, now you will discover that a retail shop will use its own stock, right? But in our case, you find that a bank actually uses uh, the public saving, right? The savings of the public, or other people's money. Okay, and that is why you find that we heavily regulate banks. So banks are heavily regulated. They are one of the most regulated institutions. Why? It's because they are dealing with public funds. Okay, that is very critical for you to remember. Okay. Um, Other than that, we also have another characteristic of profitability and saving. I mean, and service. Okay. So what we are saying here is that, of course, a bank is profit seeking, right? But it also has to be service oriented. A bank needs to make money so that it can survive. Okay, it can't survive without money, so it needs to make money. But what we are saying is that, much as you are profit seeking, you need to balance the interest of profit seeking, but also with that of safeguarding public funds. Okay, that is very important. Okay, so basically, you have a course, in your third year, um, which is the regulation of the financial system. So in that course, we'll again go through, I think it should be BF 390. Okay, so in that course, you will actually discover that this is the foundation right here of that course. The foundation is this tension that we're just talking about, the tension between profit and responsibility, right? The tension between profit and responsibility. okay, is basically the foundation of that course that we'll do. But this is very, very important. Next, we are saying that, and I think we may have addressed this one already. We talked about the issue of public deposits, okay, are repayable on demand after a fixed period. Okay, what we are saying here is that these deposits, for instance, if you put your money in a current account today and you want to actually withdraw your money tomorrow, the bank just has to give you that money, right? Okay. And so because of this, again in regulation, you will discover that because of the the need for the bank, because of the need for the bank to honor these withdraw request, then the bank has to be liquid. So it has to have enough liquid assets, right? And also you find that from the regulatory point of view also, there's what we call the statutory reserve ratio. Okay, statutory reserve ratio. Okay, okay, reserve ratio also has to be respected, okay, so that you are able to honor these obligations quickly. The other characteristic is that it has to be a structured entity, it has to be a legal entity. Okay, so we need to know under the company law, how are you operating that? Okay, all right. And then yeah, so it has to be properly constituted, in other words. Okay, and it must be authorized. The last one, and this is also very crucial, important, especially in our context today, um, the fact that a bank has to be licensed. So for you to operate, you will need to be licensed. Okay, and what we are saying is that in the case of Zambia, for example, you cannot simply call yourself, a bank and then start taking deposits. You can't do that. Okay, that is actually a criminal offense. Okay, under the the Banking and Financial Services Act. Okay, the BF Okay, so basically those are the key characteristics. Let's see if we can make some more progress. Yeah. Okay. So let us move to the economic role of banks. I think so far we have done a number of things which are making a lot of sense, especially for us bankers. I think we have established the we have now known what a bank is, why it matters so much. I think we now have an idea. Now we have to go to the economic role of the bank, right? Very important role this, because to the extent that actually when a bank is failing, it will make so much headlines, and it will cause the government to intervene and so on and so forth. So why this fuss about banks? What is its economic role, right? So why do banks exist? What are the core functions, and why the system basically matters? Okay, so there we go. So the key or the core economic functions of the bank, as shown there. The first one, which is very visible, is the payment role of the bank. Okay, yeah. So really, every time you are trying to use maybe your debit card, or maybe you want to pay your bill via your mobile money, or even when like a company is running its payroll system, that is being done through the bank. In other words, the bank is processing a payment. Now you can imagine if we didn't have this infrastructure that the banks are bringing, it simply means that commerce as we know it basically comes to a halt, isn't it? Okay, we go back to the Stone Age. Okay, so So basically, that is that. Really, imagine trying to pay for your university fees, for example, in cash. That chaos. You have to walk to the office. There has to be the issue of counting notes. I mean, that is too much. So what we are saying is that the banks are making payments, to be digital. First of all, you are able to see now that payments are digital. They are making payments to be fast, and they're making payments to be reliable as well, right? Otherwise, this is a key function. Yeah. The next one is that of a guarantor role. Okay. Basically, here what we are saying is that it is involved in, especially in international trade, right? It is involved in issuing what we call a letter of credit. Okay. Basically, this is a guarantee, and it usually comes up because of the trust issues, really. So imagine you're trying to import something, maybe from China. Now you cannot simply send your money and then hope that your goods will arrive. I mean, that can't happen, right? So then what usually would happen is that and also, anyway, even the exporter from China can't just send the goods and then wait for you to send the money later on. I mean, it doesn't happen that way. So the best that can happen is that the bank can guarantee, okay, um, uh, it's like a formal promise, really, that if our customer cannot pay, we will pay. Okay, and that's basically why we are saying that the bank is acting as a guarantor. Okay. Other than that, we also have the agency role. Okay, that's also very important. Okay. Basically, here what we are saying is that um, yeah, sorry, the agency role. So yeah, so the bank is acting as an agent, isn't it? So it is helping you like manage your estate. Okay, basically helping you handle investments. Okay, it can actually even execute instructions on your behalf. Okay, and critical, we are saying that a bank will act as a fiduciary. Okay, now what do we mean by fiduciary? All we mean is that the bank must always act in your best interest. Okay, the best interest, okay, of the customer. Okay, okay, and not itself, right? That's what fiduciary is just talking about here. Okay, so that is that. I think there was also risk management role. Um, yeah, so really banks will help clients, plan for unexpected losses. Okay, remember that we are living in a world of uncertainty, so the bank can help, in terms of selling insurance, for example. Okay. Apart from selling insurance, banks can also advise on how you can hedge your risk. Okay, like what products can we use, maybe derivatives and so on. So the bank will be there to advise on risk issues. Okay. Yeah, and just basically helping manage, the financial risk on behalf of the clients. So that's a very key role as well there. Um, yeah, we also have safekeeping. Okay, so the bank can actually hold valuables in safe custody. Okay, yeah, so it basically provides custodial services, okay, for valuables and financial assets. Okay, yeah. So physical things like maybe your title deeds, your share certificates, if you have bought some shares, or even if, like, when you want even your your financial assets, such as a foreign currency, maybe some dollars, Okay, it can basically safeguard that on your behalf. Okay, yeah. So yeah, so it not only physical assets, I mean even digital assets actually and financial instruments, all that can be in the custody of the bank. Finally, this is the role that we have constantly been talking about and will continue talking about, the intermediation role. Okay, but by now I'm sure you know what this is. All we are just trying to say here is the connection between the surplus unit and the deficit unit. Okay, that is basically what is there. Okay, so we are mentioning it here again because we know that this is providing the foundational role, okay, that underpins everything really. Okay, so whatever you do, please do not forget the intermediation role of the bank. Okay. Okay, so why does the banking system matter? Okay, why does the banking system matter? Okay, the first one is that it helps to reduce the search costs, right? Okay, because what we are saying is that without the bank, savers and borrowers would have to find each other directly, and that is not very possible. Okay, imagine a farmer in Choma with 20,000 in their saving, trying to find someone in Lola who needs that exact 20,000, at the exact period, by the way. I mean, that is just tedious. Okay. So really what we are saying is that the search cost would be too much. Okay, but because of the bank, we are able to basically eliminate the problem. Okay, because savers will take to the bank and borrowers will go to the bank to borrow. That's it. Good. What else is there? It's also about the issues of information asymmetry. Okay, this is very important as well. So banks basically help reduce what we call information asymmetry. Okay. Um, yeah, because really banks are specialists at assessing credit worthiness. So information asymmetry is a situation where one party has more information than the other party, right? Okay. So for instance, when you apply for a loan, for example, right? You yourself, like as a customer, you know more about your ability to repay, right, than the bank would, right? And so yeah, that is information asymmetry. But over time, banks have developed a lot of sophisticated systems, because they can actually do, as bankers we can do credit as scoring, for example. We have systems for credit scoring. Okay, we have systems for financial analysis. Okay, we can do the financial analysis. And basically banks can actually also do, and this happens a lot, we can actually do site visits. Okay, just so that we are sure about your credit worthiness and your ability basically to pay back. So because banks can do this and they're experts at this, then they are bridging this information gap. Okay, and are able to decide who is credit worthy. Okay, I hope that makes sense. We're moving on. The next one is about maturity transformation. Okay, this one is also quite interesting, because what we are saying here is that for most depositors want to keep their money for a short time. You find that maybe a depositor is only keeping their money for maybe just a few months, right? Like these short-term deposits. But the bank, okay, or sorry, or on the other side now, the borrowers, maybe like someone trying to build a house, they will need that money for 20 years. You see, that is a challenge already. That is maturity mismatch, because someone is keeping their money for a short period of time. Meanwhile, there's on the other side of the equation, there's someone who wants to borrow money for a longer period of time. But what we are saying is that banks have got the ability to transform these short-term deposits into long-term loans. Okay, I mean, this is something that an individual can't do, obviously, right? So that's why the banking system matters. I think we were able to see from the previous slide that it is also the banking system also matters because of the payment infrastructure. Okay, it is providing this payment infrastructure. Okay, okay, okay. So the system is able to to enable the whole economy to grow. I think we have talked about the payment infrastructure. Finally, we are also saying that a weak banking system, is it can be an economic disaster. That's why it matters. Okay. Um, yeah, because if you look at countries that have experienced, for example, like the banking crisis, you'd find that it's a situation where like credit dries up, right? And usually, like when credit dries up, then you find that businesses can't borrow anymore, right? So in short, investments basically collapse. Okay, and because investments have collapsed, then you find that even unemployment all of a sudden rises. That's what the problem is. So that is why, just based on this, that is why the government really has to do a good job in regulating this system, because a lot of things come to a standstill if this sector is not functioning well. Okay, so as we will be doing the other course in the future, which is the regulation of the financial system, I think you'll be able to appreciate why the banks are heavily regulated. Okay, yeah, it is because of this reason actually. Okay, okay, fine. So let us see if we can bring it home a little bit. We have been looking at this a bit generic, but now if we bring it home, what we are trying to say here is the issue of licensing and regulation in Zambia. Okay. Yeah. So how basically are you getting your license in Zambia and so on and so forth? But for these questions, you need to know that there is a very important piece of legislation, and it is the Banking and Financial Services Act. Okay, Banking and Financial, Services Act. Okay, so the Banking and Financial Services Act is a very important piece of legislation. Why? Obviously, it's because it is defining what banking is. Okay, it is also telling us what happens when players break the rules, for example. Okay, yeah. So who can do banking? All that you'll be able to see from the act. Okay. Now, when it comes to regulation, obviously we have got Bank of Zambia. Okay, this is our central bank. Okay. Yeah. Okay, and then we also have yeah, we also look at the licensing pathway as well. Okay, fine. Now what are we saying? we are saying that the act, when you look at the regulatory framework in Zambia for banks, the act is basically governing all banking activities in Zambia. Okay, like I have mentioned. Okay, everything about licensing, about operations, about supervision, you find that in the act. A very important act for us bankers. Even the issues of enforcement, such as penalties or fines, is found in the act. Okay, but really, what we are saying is that operating, okay, without a license in Zambia is a criminal offense. Okay, so no entity, okay, this is very important here. No entity, okay, may conduct banking in Zambia without a valid license from the registrar. Now, who is the registrar? The registrar is an officer, and working, at the Bank of Zambia. All right. So some of the things about the Bank of Zambia that we'll need to talk about, I think, a little bit later. But for now, I'll just mention is that, you see, Bank of Zambia is responsible for the monetary policy. Okay. So in other words, issues to do with interest rates, issues to do with money supply, okay, and basically just overseeing the financial stability, of a nation. That is all, the role of the Bank of Zambia, really. Okay. Now, it houses, like I mentioned, it houses the registrar of banks. So the registrar of banks and financial institutions. Really, the registrar is a single person, but obviously backed by authority of the Bank of Zambia. So the registrar is important because he or she decides whether to grant, okay, refuse, or even revoke a banking license. Okay. So really, you can't go to court, you can't do anything once it is decided, because what we are saying is that the registrar is the gatekeeper, right? The registrar is the gatekeeper, and given that authority to do exactly that. So that is basically where we are. Okay, so remember BFSA and also the registrar. I think that is important. Okay, that is extremely important. All right. Okay. Quickly, when we talk about the if, for example, you want to open a bank in Zambia, obviously the question is, what must I do, right? What must you do? So there are 6 important steps. The first one is name clearance. Okay. The first one really is name clearance. So there are some forms that you have to get. Okay. And then those forms have to be filled up. Okay. And then obviously you propose the name of the bank, and this name has to be cleared by the registrar before you can even do the application. Okay. Yeah, you might ask why this is. Well, it is basically to prevent confusion with existing institutions. So you don't want names to clash, isn't it? So that's why you are getting that that name clearance. Yeah, for example, you might not name a bank like Zambia National Bank, because I mean it's already there, right? So those clashes, we don't have to have them. The next one that you need to do in your steps to getting that license is the what we call the fit and proper test. I think this is critical here. Really, all the directors and the major shareholders that you are proposing, they will need to complete a questionnaire. Okay, they will need to complete a questionnaire. Yeah, because the registrar wants to know, right? If these people, do they have any financial crime, right? You know, have they been disqualified from running a business, before, right? Are they financially solvent, for instance? Okay. Yeah, because at the end of the day, especially this issue of fit and proper, you find that the banking system is built on public trust. Okay, is built on public trust. Okay, so the banking system is built on public trust. So we really need that the people who are running these banks are beyond reproach. Okay, that's what we are looking for. So that's why it is very important to do what we call the fit and proper test. Critical also is the issue of minimum capital requirements. I think in regulations as well we are going to stress this point. But you can already know something from here, because the minimum capital requirements are needed because they are a safety buffer. Okay, they are a safety buffer. Okay, they are a safety buffer. Okay, in other words, if things go wrong, for example, maybe loans turn into bad loans, or maybe there's a financial crisis, yeah, the bank will need its own money so that it can absorb those losses, isn't it? Before they can actually begin to touch, depositors' funds. So it is like a fallback position, and it is very important. So for local banks, we are talking about yeah, something around 104 million. For foreign banks, we're talking about 520 million, which is like five times, right? Five times the amount for local banks. But anyway, in terms of the why, we'll come back to it a little bit later, and we'll discuss why this differential here. Okay. What else? We are looking for a 3-year business plan. Okay. We are looking for a 3-year business plan. Yeah, because I mean, you cannot just say I want to start a bank, right? You must demonstrate how you will run it. Okay, I think that is important. Okay, you must demonstrate how you run it. So the registrar really will want to look at the detailed business plan, at least for the past 3 months. Clearly showing the assumptions. Okay, yeah, about revenue, costs, and the market, but also even just like your strategy towards risk as well. They're interested in seeing that from the business plan. Okay. Next, there is obviously going to be an application fee. Okay, and it's about 5,000, I mean 50,000 actually, 50,000 fee units. Okay. Yeah, so this is payable when you submit your application now. Okay, yeah. The sixth stage is the on-site inspection, definitely. So we need to see that you have the things that are needed. So yeah, so physically the premises will be inspected. Okay, yeah, okay. Just checking everything, that everything is matching what is on paper. Okay, yeah, and then after that, then you are now considered for licensing. Okay. Okay, all right. Quickly, what else can we look at here? Okay, yeah, so here is just the key licensing requirements at a glance, really. Yeah, so like we have been arguing, we have been saying that um, you know local banks in terms of capital requirements is like 104, whilst minimum for foreign banks is like 5 times, right? 5 times more. In fact, you can even do the calculation. 104 multiplied by 5, it's I think it's 520, right? Yeah, so it's exactly 5 times that of local. That's here in Zambia. Now, I think I had posed this question and said we needed to answer it a little bit later. Actually, these are some of the exam questions that we need to get familiar with. But really, think about it. Why are we asking or demanding more, from a foreign bank in terms of capital requirements? I think one of the things that you need to just appreciate here is that when you look at foreign banks, they are carrying some kind of like additional risk. What do you mean? What do we mean? These foreign banks, when they have a subsidiary here in Zambia, for instance, this subsidiary, is subject to the decisions of the parent company overseas, right? And then the thing is, you'll find that these decisions that are being made will not consider the Zambian depositors, and that is where the problem is, and that's why we are trying to protect the Zambian depositors because of that risk. Okay, and also like if a parent company, for example, gets into trouble abroad, it might want to maybe pull funds out of Zambia. Again, our Zambian customers or depositors, clients, might be affected there. Okay. Yeah. And yeah, so basically this higher capital requirement is a buffer against such systemic risk. Okay. Such systemic risk. Okay. Yeah, I think other than that, I think another point could be that really this higher capital requirement, um, I think it's a signal, right? It is a signal that a foreign bank is serious about a long-term commitment to the Zambian market. Okay, so basically that. Other things that you may need to look out for are what is the maximum time allowed to, I mean, the maximum time for the registrar to respond to an application. Ideally, it's 180, 180 days. That's the maximum time, that the registrar has, to process a complete application. Okay, we've talked about the issues of 500 fee units already. Um, 3-year plan with explicit, okay, with, I think this is critical, with explicit assumptions. Why? Okay, we might ask that question as well. Okay, but really these are key, these assumptions that we are trying to get. Why are we doing this? We want to test viability. Okay, I think that's one point here. We want to test viability. That is, will this bank survive? Right? Will this bank survive? What else are we trying to do? These assumptions are setting benchmarks, right? They set some kind of benchmarks so that if at any point management maybe deviates, then the registrar can question why, right? So those are the things, but also um, putting up these explicit assumptions, protects. Okay, it protects future depositors really. Okay, future depositors. So that is very, very, very important. Okay. So yeah. So I think we have done quite a lot here. Yeah, I think we've done quite a lot. Let's see what else. Okay, so yeah, I think the final part of today's discussion really is you need to know that you cannot be allowed to open a bank minus an inspection. Okay, so before a bank can actually open its doors to the public, certain things have to be in place, and inspection will be done to ensure that those things are in place. Yeah, so there will be obviously an on-site inspection. It means yeah. So obviously this is non-negotiable. So they will check. Bank of Zambia will check for for security. Okay, how is the security at the premises, for instance? Okay, things like are the equipments in place, obviously. Okay, so that we see, is the bank really ready to serve the public? Okay, the next is we are also looking for mandatory equipments. So in terms of like the safes, we need them to be available. Okay, not counting machines, we need them. Not detectors to prevent fraud, obviously. Okay, and handle cash securely. So those things, would have to be patient. I mean, would have to be present. Sorry. Okay. Yeah. I know, like, especially for counters, detectors, it looks like they are so basic, right? But really, they're so critical for preventing fraud. Okay. And remember that this is like one of the biggest problems in the banking system right now, the issue of counterfeit currency. That's a big, big problem. So by doing that, it's a first line of defense, right? It's a first line of defense. Um, Now, third is yeah, obviously security measures. So do we have our alarm systems? Okay, are we able to? Do we have security guards at our premises? Okay, yeah, I think that is also important. Okay, so yeah, and then also there's the issue of anti-money laundering. So we need to see that there is a dedicated officer that can respond to anti-money laundering issues. Okay, that is also very, 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 very important. If you don't have that as a bank, a lot of fines can follow you, and you can even lose your license actually. Okay, you can even lose your license. Yeah, so that is very key. But especially as you know, there's going to be international business that we'll discuss towards the end of this course, and understanding some of these, anti-money laundering issues, the fact that it is not just a Zambian requirement, but coming from a global, uh, you know, uh, you know, perspective. So we need to understand this, obviously. Okay, but we'll talk about it a little bit later, and in the next notes that we'll look at. Okay, let's finish it up. Due to time, what are the key takeaways? Please notice that these are the key takeaways. You can have your own time to look at them. And then finally, I would like us to, in our own time, or if at all we can come up with groups, let us see if we can discuss some of these questions, right? Why does the registrar require, a 3 year business plan with explicit, assumptions before granting license? So that you can discuss and then improve on that. A scenario also of how you can the steps you need to follow, right, for you to open a bank, and then how does the financial intermediation benefit the Zambian economy, and then I'm asking if you can give two examples. Yeah, otherwise, yeah, I think this was really a good a good build up. I think we have managed to lay the foundation. Okay. At least now we know what a bank is. We can appreciate that. Like, why does it even exist? I think even the role that the bank is playing in the economy, we can be able to appreciate that now. Okay. And then obviously, what does it take to become a bank in Zambia? Okay, so we'll continue building this on, especially in unit 2. We'll be able to discuss some more things. Otherwise, for now, let us go through these notes, understand them, and then we'll meet each other in the next session. Thank you.